The Federal Reserve acts as the primary architect of American monetary policy. Currently, the officials inside this building are preparing a pivotal interest rate cut to begin a new cycle of monetary easing. This shift is occurring while the benchmark S&P 500 trades at historic all-time record highs. Since 1996, this exact convergence, cutting rates while the market sits at its peak, has only happened two other times in the modern financial era. This contradicts standard economic theory, which suggests central banks only reduce rates during periods of acute economic weakness, severe labor market distress, or when equity valuations are deeply depressed. To audit the current market's strength, we look at aggregate metrics like trailing and forward price-to-earnings ratios and the Shiller tape. The price-to-book ratio of the S&P 500 has expanded to 5.3 times book value, moving past the 5.1 times recorded at the absolute height of the dot-com bubble in March 2000. These collective metrics now exceed the speculative peaks recorded immediately before the 1929 Great Depression. That era was defined by a massive gap between soaring paper valuations and the physical economic reality facing the public. In a typical cycle, these extreme valuation percentiles would force the Fed to tighten policy. Their rush to cut rates suggests the headline market averages are failing to tell the full story. Wall Street justifies these inflated equity valuations by pointing to a specific shift in the global economy. This argument relies on the integration of enterprise artificial intelligence, advanced robotics, and digital automation into the core mechanics of business. Proponents claim these technologies will permanently expand corporate profit margins and support these historic valuation multiples through massive productivity gains. This area chart shows headline gross domestic product growth expanding at over 3% annually, providing the primary data point for those who believe the economy is thriving. We must investigate whether these automation gains are building a stable foundation or if they are masking a deeper erosion of the broader economy. To find the answer, we have to look past top-tier corporate profits and examine the underlying mechanics of the domestic labor market. Despite the growth in GDP, the labor foundation is currently showing severe structural fractures. Independent economic surveys tracking consumer employment perceptions offer a direct view of this decline. This line graph shows the index of individuals reporting that jobs are plentiful. This index has plunged over 20 points from its recent peak. This collapse occurred within a highly compressed 2-year window. The current reading is now at its lowest absolute level since 2021. This data reflects the rapid acceleration of workforce reductions and hiring freezes currently moving through the corporate, financial, and white-collar professional sectors. Automated enterprises are seeing record-breaking wealth, while the foundation for the white-collar workforce begins to break. Central banking officials are currently facing a deteriorating situation that corporate earnings reports can no longer ignore. Because of the deepening fractures in employment, policymakers are now moving to accelerate interest rate cuts. They are utilizing this weakening labor data as the institutional justification to inject monetary liquidity back into the financial system. This liquidity injection is a defensive move, aiming to stabilize the system before the rising pressure in the labor market leads to a cascade of credit defaults. The record-high stock market functions as a temporary float above a fractured economic system that the Fed is desperately trying to patch. Historical data reveals a perfect success rate for equity holders in a specific environment. Since 1980, every time central banks executed rate cuts while equities traded near record highs, 20 out of 20 occurrences, the S&P 500 finished higher 1 year later. Over that 12-month window, the average annual return reached 13.9%. This figure often becomes the primary benchmark retail investors use. However, focusing on a 12-month horizon obscures the short-term market dynamics immediately after the policy shift. During this immediate window, liquidating risks frequently emerge that the average investor overlooks. Tracking reveals that in half of these historical cycles, the index suffered a sharp downside pullback exceeding 10% within the first 30 days. To achieve the positive annual average, the market first had to endure acute, immediate volatility. This sudden drop often forces retail liquidations. As investors sell to preserve remaining capital, institutional holders, who have the reserves to wait for the recovery, effectively absorb that equity. It is a massive transfer of assets from the working class to sophisticated holders. The 13.9% return is a real number, but it acts as a mask. It hides a high-stakes volatility trap designed to shake out weak hands before long-term compounding can actually begin. These incoming interest rate reductions are enter higher than the central bank's mandated 2% target. Injecting fresh monetary stimulus into an economy with an expanding M2 money supply creates a mechanical reaction. It generates a powerful tailwind for scarce, fixed-supply financial assets, regardless of the broader economic health. quantitative tracking models plot global M2 money supply expansions against digital and hard assets. This data shows that assets like Bitcoin and gold follow liquidity spikes with a consistent 60 to 90-day lag phase. Because this lag is structurally documented, sophisticated capital can position itself before the nominal price of assets inflates. They capture the expansion of the money supply before it reflects in the public price. Rate cuts function like a delayed fuse pump for financial assets. The value of these holdings increases mechanically, often remaining entirely disconnected from the reality of rising consumer costs. To see who actually benefits from this mechanical pump, we can look at official financial statistics published by the Federal Reserve registries. Federal data reveals extreme concentration. The wealthiest 10% now owns 92.5% of all equity and mutual fund shares nationwide. By contrast, the bottom 50% of the population holds a historically depressed 2.6% of liquid financial assets. As monetary easing inflates nominal asset values, it protects corporate balance sheets and heavy investors. But non-asset owners face a different reality, a direct erosion of their purchasing power. Living expenses and real estate costs scale far faster than baseline wages. The money earned through labor buys less every year, while the value of the assets owned by the top decile continues to climb. Within a fiat monetary architecture, the wealth effect of rate cuts is a zero-sum game. It compounds domestic inequality by rewarding the ownership of assets and penalizing the earning of wages. This timeline highlights a structural pattern dating back to the late 1980s. The shaded vertical bands identify periods of official economic recession. Historically, the initiation of an aggressive rate cut cycle almost universally precedes these shaded regions. These policy shifts function as reactive attempts by central banks to soften the impact of incoming credit contractions. For investors operating in this environment, surviving these volatile transitions requires moving away from retail behavior and adopting a strict capital shield. The financial shield requires 3 layers: liquid cash to absorb market pullbacks, continuous index assets for long-term compounding, and inflation-hedged instruments to preserve purchasing power. In a system designed to inflate away cash, active protection and understanding the reality behind the average return are the only paths to preserving wealth over time.